So colleagues, a very warm welcome from the OECD in Paris. I'm Haje, I'm heading the work on financing for sustainable development, and unfortunately I cannot be present with you in Paris, but I will see myself big on screen present in the room. So it's my great pleasure to moderate this session. Before we have a keynote speech and a panel, and I'm really looking forward to that, let me say a few words about the session. So the session is about scaling up green, social, and sustainability bonds in emerging markets. As we all know, these kind of bonds have got a lot of traction during the last years in developed markets, less so in developing markets, despite the fact that I think we all agree that there is a huge potential basically for this instrument to further advance the financing for sustainable development investments in support of the SDGs. And we will be looking basically at the key challenges, why this is the case, and what can be done and overcome to these challenges, and obviously the catalytic role that public development banks can play in overcoming these challenges, as they have been in the past. Obviously, we're all aware that public development banks have played really a key role in already establishing these instruments to the extent they are in developed markets. So my little intro here will be followed by a presentation by Jorge da Silva, a director from the OECD. He has a background in politics, having had high-level positions in the government of Portugal. And he will tell us more about the joint report that the OECD, together with CDP, the Cassa Depositi, Prestiti, did on basically on this instrument and what can be done in order to scale up for the G20. And we are very happy that this report has been acknowledged by the G20 and is leading to some kind of high-level principles on the subject matter. Thereafter, we will have a panel, 5 panelists. Great to have you all with us today. We have James Scriven, he's the CEO of IDB Invest, coming from a distinguished career both with the IFC but also in private banking. Then we have Alain Tchibozo from the West African Development Bank, BOAD, followed by Anita Bhatia. She is the Deputy Executive Director of UN Women, as well as the Assistant Secretary General of the UN. Then we have Jan-Martin Witte coming from KfW. He is the Director and Head of Global Equity and Funds. And then last but not least, from the OECD perspective, our partner in crime, and when it comes to the report, we're really happy to have Marina Piccioni with us, and she's the head of global funds and equity, sovereign multilateral financing and lending and partnerships, obviously with the CDP. So great to have you all, and we look forward to engaging 45 minutes. So our session is a little bit shorter than previously foreseen. So we'd like to ask everybody to be really to the point. And with that, George, over to you, please.
Thank you, Haje, and I'd like to thank Antonella and all colleagues from Cassa Depositi Prestiti for this partnership on our work to scale up green, social, and sustainability bonds, or GSS bonds, in developing countries. This work within the Development Cooperation Directorate is coordinated by Haje, that is our moderator today. I want to start with some important context. COVID-19 has widened the financing gap, as we all know, in achieving the SDGs in developing countries. The crisis indeed magnified the financing needs while putting constraints on resource availability. Our estimates demonstrate that external finance declined by at least $250 billion. In this context, green, social, and sustainability bonds hold the potential to bridge the SDG financing gap and get us on a path towards a more equitable and sustainable future. with around $120 trillion in value outstanding. The global
It seems that we may have lost George. Let me wait for a moment, hoping that he will come back. If that is not the case, could I see the room, please, kindly? Excellent. Thank you so much. What I would suggest is that we go to the panel and have the keynote views by the panel coming now, and we have then George joining later to continue to give the overview. This is obviously not the way it's planned, but I think it's the best that we can do. I hear, George, we have you back again. So, George, kindly continue.
Yes, I'm sorry. I've been doing this all day, and it's the first time that I'm facing the problem today. I'm really, really sorry. And I was in a moment where I was emphasizing that the growth of the GSS market in recent years, including through issuance in emerging markets, as Haje just mentioned at the opening, shows very positive signs that we are moving in the direction, in the right direction already. Despite the strain that the pandemic put on financial markets, the size of the GSS bonds market almost doubled in 2020. And this is quite impressive, with $700 billion worth of issuances. And especially welcome development is the rising number of developing country governments that make use of GSS bonds to raise capital. Among the 22 governments who have issued sovereign GSS bonds, there are developing countries such as Indonesia, Mexico, and Nigeria. In response to the social needs that have been exacerbated by COVID, some developing country governments have responded in pioneering innovative instruments adopted to local contexts. Let me just give you one example. Ecuador launched the world's first sovereign social bond to provide affordable housing to lower income households. But another example, Thailand issued a sovereign sustainability bond to finance green infrastructure as well as social impact projects to assist with the COVID recovery. However, significant challenges remain for the GSS bond market to reach its full potential. Although it is growing, the market constitutes only a fraction of the global fund bond market, representing only 1%, I repeat, 1% of total assets outstanding and around 2% of new issuances. And it is still considered a niche sector. Moreover, the GSS bond market is mainly dominated by issuers in developed markets, with developing country issuances representing only a small share. In 2020, Europe and North America accounted for about 50% and 20% respectively of global green bond issuance. The recent stocktake report that we prepared with our colleagues from Cassa Depositi Prestiti, at the request of G20 presidency from Italy, points out measures that are necessary for developing countries to benefit more from the issuance of GSS bonds. So in these initial remarks, I was emphasizing the need for change. Now, in the next couple minutes, I will just outline some of the conclusions of this report to overcome the obstacles. First, there is a need for technical assistance to meet requirements for GSS bond issuance and to identify suitable investments. Often, investor demand in GSS bonds from developing countries cannot be met due to a lack of bankable projects. pipelines of green, social, and sustainability projects need to emerge at the scale to effectively tap into the bond market. There is also a lack of awareness among policymakers in developing countries about the costs and benefits of GSS bond issuance. Official guidance on bond issuance procedures could allow developing country issuers to better understand how to meet the criteria for a green and social label. Creative thinking and capacity building can also be helpful in diversifying the uses of GSS bonds towards a greater range of sustainability goals that which include gender and biodiversity. Second, the credit quality of GSS bonds can be enhanced to stimulate more investor appetite. Difficulties in obtaining internationally recognized credit ratings are another key challenge. Many institutional investors, such as insurance companies and pension funds, are bound to old investment grade debt. Blended finance instruments, such as guarantees and first credit loss mechanisms, can be crucial in catalyzing private sector investments by leveraging their funds to absorb part of the GSS bond risks. Donors can demonstrate the viability of projects with sustainability objectives, but also diversify the investor base for developing country debt and help mainstream the GSS bond market. And finally, for GSS bonds to take off as SDG financing sources for developing countries, there is a need for more transparency. Reassuring investors about the project evaluation and selection process is key to build confidence and scaling markets. Recently, there have been some efforts at international and national level to improve transparency through the introduction of taxonomies and standards, but more needs to be done to promote harmonization across the different standards, and developing countries will need support to adopt and implement the standards locally. Harnessing the potential of the GSS bond market to close the SDG financing gap is an endeavor that cuts across a broad set of actors, including the public and private sector, as well as multilateral and bilateral development partners. And we look forward to continue to support these efforts in providing visibility and transparency on GSS bonds, including through the G20, a critical body to advance the work on developing GSS bond market that includes both developed and developing countries. Thank you, Haje.
Yeah, thank you so much, George, to give us all a snapshot of the report that is online and launched, and that obviously we invite everybody listening to have a look. Now we are moving to the panel. It's great to see you all, both physically, but also in Rome on the ground. And we have basically sharing of key views from the panelists, about 4 minutes each. And then we hope to also have a bit of time for Q&A, and would welcome any questions that the plenary have to send this via the chat function to us, and we will address this then to the panelists. With that, I wonder whether we have James Scriven with us from IDB Invest, I guess from Washington, coming in to give the first view from the panel. If that's not the case, then let me move on to the second panelist, and that is Alain Tchibozo, Chief Economist from the West African Development Bank. So please, Alain, you have the floor.
Thank you very much. First of all, it's a pleasure to be with you, and it's an honor. Let me give you 1 or 2 words on who we are, Banque West Africaine de Développement. We are the development bank for the 8 countries of the West African Economic and Monetary Union. We are talking here of 130 million people, living in these 8 countries. This is today. And we all have in mind that 20 years down the road, we should be talking around 300 million people. So that's clearly a challenge. The second challenge is that 60% of these people are still living in rural areas today. And this is changing. Most of these people are migrating in cities, cities which are not ready today to accommodate them. And the third point in our area, we talked this morning about agriculture. What we know is that on 1 hectare in our region, on average, we grow 1 ton of cereals a year, which is to be compared with 5 or 6 tons in Europe and 8 tons in the US. So you understand that today we do have a problem of productivity in agriculture, and 20 years, when the population will have doubled, this gap will be massive. So it's not a question whether we need to invest. We have to invest. We have to invest in productivity. All our governments know that, and that is why when you combine all the SDGs, the 2021, 2020, 30 commitments the governments have, you come to a number of $130 billion to expense in the next 9 years. Definitely this money is not here. This money, we're not going to find it with IDA. IDA is already overused in security-related problems, in post-COVID issues, and these countries cannot either borrow money on the market because of these ceilings on their debt to GDP. So you see, the question of finding an alternative source of financing is here today. And I must say, in our experience, green bonds is a good opportunity. What happened is that, and that happened in January 2021, earlier this year, we issued the first, BOAD issued the first sustainable bond. At that time, we were looking for long-term maturity and for low interest rates. And to be fair, knowing that our countries today borrow money above 5% a year, we were happy if we managed to get less than 3%. The outcome is that we managed to raised 750 million on 12 years maturity. We paid 2.75%. And to be fair, the demand was 4.4 billion. So definitely, sustainable bonds, there is a way to use to leverage funding to finance our development. So that's the first thing I can say. The second thing I can say as well is how come, what's the trick to make sustainable bonds successful? Actually, we used sustainable bond format which was very clear. We had 3 commitments to investors. First of all, we explained the use of proceeds, what we're going to do with the money. The second thing, we explained how we're going to manage the portfolio across the cycle. And the third thing, we committed to transparency, what you were referring to earlier. Yes, transparency is key. We committed to provide annual report of what we are doing with the money. So the first thing is, when we started, we identified for 1 billion of projects which were eligible to the social framework. We're talking of 50 projects, 47 of them were social, 3 of them were green. That's the reason why we decided to go for social bond, ESG, rather than to go for classical green or climate. We needed to be fair with investors. We knew that our issues were more social than anything else, so we clearly said we want to issue a social bond, ESG, and that worked. And the kind of project we have was clean water in Mali, social housing in Benin, schools in Senegal, so really social. So the message to investors was very simple. Basically, your money will have impact. And they got it. The second thing we did is to explain evaluation. Twice a year, we evaluate the project. And when we find that one project becomes ineligible for any reason, we commit that before 6 months, we will have changed this project and put a new one eligible. And this is very important. The message was, your money will always be on impact project. Don't worry. And then we came to the third point, the reporting. Reporting, first of all, we audited our process, and this was Vigio Iris. Vigio Iris looked at our standards, the way we manage the portfolios, the way we organize our operations, and the conclusion is BOAD got the higher rating. And the second thing is, once we issued, we committed every year to make public to the audited report. So we have an audited report, it is public, it is on our website, and every single investor can track what we did with the money they gave us to manage on their behalf. So if I was to summarize, I would say, and I totally agree with what you said earlier, point one, yes, we can plug private money to public development, and we can do this with generating money at concessional or almost concessional rate. And we all know, and that we also indicated this morning, we all know that we cannot continue to provide funding to finance development at rates which are too high for our agriculture. So that's the first message. And the second message is, yes, we need to use standardized process, and we need to make everything transparent so that all investors will get confidence in what we do, in our assets, because we have assets. And if we manage to do our part, i.e. providing this financing, and we manage to find good assets, we believe that this is a good thing that can happen for the future in terms of the development of our areas. That's roughly what we can say.
Excellent, excellent. Thank you so much, Alain, for giving us this insight into a very successful issuing of a green bond and a social bond by your institution, and giving us a couple of insights what helped really to have an oversubscription and good terms, obviously, for this bond. With that, I would like to turn over to you, Anita Bhatia from UN Women, and please share with us your key views. Over to you, Anita.
Thank you very much, and good morning, good afternoon, good evening. It's a real pleasure to be with all of you at this important meeting. And I'd like to just start by saying something which I think we've been hearing about right through the pandemic, but bears repeating as context for our discussion today. And that is that, for us in UN Women, we have seen over the last 18 months how the COVID-19 pandemic has really disproportionately impacted women in many different ways. The three ways that we think about this impact are on income, on health, and on security. And basically, because we have seen a huge drop-off in female labor force participation, because we have seen negative impacts on women's health, and we have seen huge rises in violence against women, we are very mindful of the need for both public and private sector to come up with innovative solutions to these challenges, and also mindful of the fact that some of these solutions will have to be financial solutions. And so we see a real need to direct more financing towards gender inequality issues, which have really gone up during the pandemic. And I want to start by just acknowledging what Jorge said at the outset, that the market for green social sustainability-linked bonds has grown exponentially. But when you actually look at how much of that market is specifically aligned to SDG 5 on gender equality, it is less than 1%. And so I think we can safely say that capital flows are not yet on track to meaningfully contribute to SDG 5. And while there has been an increase in the number of social bond issuances, these have been, as Jorge pointed out, mainly in the developed world. So, we're very heartened by some of the progress that have been made. We have seen that multilateral development banks, IFC, my former employer, IDB, and others are, doing a phenomenal job of making sure that there is more financing being driven towards social goods. But the question of gender equality is, ladies and gentlemen, I would say, not being adequately addressed. Now, we have seen some interest in gender bonds. We know that, for example, in Chile, 3 women's bonds have been issued by Banco Estado since 2016. In Mexico, we saw last year that FIRA issued 1 gender bond. But my overall message to this audience would be that public development banks need to focus much more on the gender theme in the overall GSS bond market. And because public development plans play a multifaceted role as anchor investors, as mobilizers of private finance, as providers of technical assistance, and as supporters of policy reform, and because we know that there is a demand for these bonds and that the demand is higher than the supply available, and that investors are actually adopting strategies to measurably use capital to address gender gaps, we feel that the time is ripe for a real transformation of this market and really for the creation of a new asset class, which would be sovereign gender bonds. So UN Women is working very closely with the International Capital Markets Association and with IFC on a role that is really best suited for the UN, which is the standard setting role. So we are working to adapt the social bond principles so that they will now also be able to be applicable to gender bond issuances. And we expect to have these guidelines finalized later this year and hopefully to launch them later this year. And I want to say one more word about standard setting, because when you look back to the history of social and development bonds, the World Bank was the first issuer of a thematic bond way back in 2006. It's actually not that long ago. And, but the market has grown exponentially since that first vaccine bond, which promised to inoculate 500 million children. And since then, there have been green bonds and thematic bonds. But I am really surprised, actually, that we still have not yet seen a sovereign gender bond. And so that's the market gap that we want to close through the work that we are doing on standard setting, because the United Nations Principles for Responsible Investment, to which a number of asset managers have signed up, played a very important role in moving this market. And so we see that standard setting role for us as being very important. And a sustainable bond which has a focus on gender can be very useful. But can you imagine that if we have a country that comes out with a gender bond, it really is a very important signal of that country's leadership and commitment to addressing one of the key challenges of our times, which is gender inequality. So in addition to the support that we're doing on the standard setting side, UN Women is very closely engaged in working with the international financial architecture to really to get a focus, more of a focus on gender equality in actual transactions, in lending and in policy advice. And that is why we are so happy to have been part of the work of this group and to have been part of the work that is going to lead to the launch of, the report of this summit. So thank you for allowing us to share these short reflections, and happy to answer questions. Back to you.
Yeah, thank you so much, Anita, for this very succinct pitch for the introduction of sovereign gender bonds as a new asset class. and the opportunities that there are also for our colleagues here from development banks out there. With that, I would like to shift our discussion, the panelists, to Jan-Martin Witte from KfW to share his perspectives on the subject with us. Over to you, Jan-Martin.
Is the microphone on? Yes, it is. Good afternoon, everybody. Thank you, first of all, to the organizers for inviting me. It's a pleasure to be here with you and with you in the audience and out there on the internet. And I would also congratulate the OECD and CDP on the stock-taking report, which is a great read. So for those of you who haven't read it, download it, read it. It's an informative piece of work. I would just like to make 4 or 5 points from KfW standpoint with regards to the green and social bond discussion, echoing in parts what previous speakers have already noted. Clearly, and also as the stock-taking report emphasizes, green and social bonds have emerged as somewhat of a growth industry in the last decade. And from our standpoint, that is a good thing, because clearly if you look at the funding requirements that are needed in order to achieve the Sustainable Development Goals or the Paris Climate Agreements, we need that capital. So for us, capital market instruments like green bonds are just one more important conveyor belt through which we can mobilize capital from institutional investors, from pension funds and others to achieve these objectives. And we need that cash, and we need it urgently, as also Alain has already pointed out. That's point number 1. Point number 2, and for those of you who know KfW, they will know we've been part of the early stage development of the green bond space. We have issued bonds worth around about 40 billion euro in the last 7 years. This year to date, we have issued 7.2 billion with a target of about 11 to 12 before year end. So we are a strong stakeholder in this market, and for us, green bonds are a key part of our refinancing strategy for the bank, and quite a successful one at that. Now, as Haje already mentioned in his introductory remarks, this explosion in growth in the green bond space in particular has been centered predominantly around countries in the OECD world. And that is the key challenge, at least for us, working in the international development space. Only about 4% of the issuance that we've seen so far are coming from emerging markets, excluding China. Now, for us, in order to move the SDG and the Paris agenda forward, we really need to unlock this space also in emerging economies. We need to bring more BOADs and more corporate issuers into this space to raise funding through green bonds and social bonds. And for us, there are a number of important levers. And the first and most important lever for us is that while green and social bonds are a great instrument to raise funding on capital markets, the reality also remains is that you need assets that you can actually put into these bonds. And for us, at least in more difficult jurisdictions that we work in as KfW Development Bank today, the key issue, to put it provocatively, is not the money. The key issue is the number of well-prepared, investable projects. So regardless of how much funding we can possibly generate from institutional investors or pension funds, it will not detract from the gigantic task we have, especially in the African space, to really increase the pipeline of bankable projects. And that is the bread and butter business, I would say, for you and for all of us working in public development banks, to put our feet on the ground, to work with our African partners, to bring this pipeline forward. If we don't move that forward, all the green bonds in the world will not move us closer to the SDGs or to the Paris climate goals. The second thing is that at this stage we see very low diversification in the issuer base. We're mostly talking about financial institutions, very few corporate issuers in the green and social bond space. Generally, especially in more difficult jurisdictions, capital markets are severely underdeveloped, so before we even can talk about green bond issuance, we need to see other bond activity in these markets. So there's a point here that we have to take seriously about market building, not just standards for green bonds, but raising the capacity of capital markets authorities, making sure there's decent regulation in place on the ground to allow for capital markets to work properly. Third point, and that relates to that, goes to the issue of local versus hard currency. Now, the bigger pools of capital are obviously denominated in hard currency, be it in dollar or euro or other currency. But the reality also is that the debt carrying capacity of most of the sovereign or corporate issuers in emerging markets is already quite stretched. If we burden them with more hard currency debt, that is going to be an issue that is going to become an even bigger problem than it is already today. So I think we need to also think about ways in which we can actually increase the issuance in local currency in these markets to really mobilize the local savings that do exist in order to finance projects in the green and social bond space. And we have several instruments in place. I can speak about that in a minute. But that to me is a key challenge, increasing the share of bonds that are denominated in local currency in these markets. Now, what do we do as KfW? Obviously, as one of the key participants in the green bond space, we have helped in various forums to help set standards for green bond issuance. For example, being on the executive committee of the Green Bond Principles for the ICMA. We've also served as an advisor for the EU taxonomy in recent years. And that is work that we will continue. We've also done quite a bit of work, and others have done as well, like the IFC, in order to help build pipeline for projects. Good old-fashioned technical assistance, good old-fashioned project development through project development funds, through project equity investment companies, and so forth. And we want to do more to build that pipeline, as I said earlier. And finally, we've also created a number of mechanisms through which we can provide some level of credit enhancement to particularly corporate and sub-sovereign green bond issuers in emerging economies. We have just launched 2 months ago a new fund with a target volume of around 500 million euros that will target the green bond space in Latin America. That is the LA Green Fund, which is a Luxembourg-based fund managed by Finance in Motion. Plus, we've already 5 years ago helped to launch a new fund, the Africa Local Currency Bond Fund, which is supporting local corporate issuers with their first issuance in jurisdictions that haven't seen a lot of activities. And they have also just last year helped 3 new green bond issuances to go to the market. That is a 200 million fund that next year, with the assistance of the European Commission's EFSD program, will rise to about $350 million going forward and hoping to grow.
Excellent.
All right. I'll leave it at that. My time's up, Haje, I see.
Yeah, it is.
Yeah, it is that way. Okay. If you guys have any questions about any of these things, please come to me after the panel. Thank you.
I'm being reminded here by the supra moderator that we have only 10 minutes to go, or 8 minutes. So with that, I have to pass on the pressure here. With that, I would like to ask Marina to share her perspective from the CTP perspective. Over to you, please, Marina.
Yeah, thank you very much. Good afternoon, ladies and gentlemen. As I mentioned, CDP is supporting the Italian presidency in the activities of the G20 Development Working Group. And one of the topics was financing sustainable development, and of course, financial instruments and capital markets play a key role for supporting long-term financing, as most of my preceding colleagues have mentioned. The goal of the Development Working Group was to identify challenges in the scaling up of sustainability related. Let's talk about sustainability related. We mentioned GSS, we mentioned thematic bonds, we mentioned a lot of definition, but the definition we would use is the broader one. And so challenges and highlight a set of high-level principles that can boost issuance and support the scaling up of this kind of instrument in developing countries. Of course, the OECD stock report has established the framework. It is a comprehensive picture, and it was very helpful in having a description of the state of the art of the evolution and the challenges of the market. Building on this picture and on what has been said since now by my colleagues, I would say that it's clear that the constraints are on both sides, on the demand side and then on the supply side. From the demand side, attracting capital, private capital, means ensuring transparency in order to overcome greenwashing concern and asymmetry of information concern by investors, but means also providing risk sharing or risk mitigation instruments in order to provide to reduce the risk profile of the investment. From the supply side, Jan has mentioned a lot on that. Of course, local issuers need to be supported. The green bond issuance as a cost, as it is not just an economical cost, is a human cost, is a capacity cost, and then it's important to building a pipeline and to help local issuer to build a bankable pipeline. So the developing working group worked on this high-level principle, and I would ask to put the slide on the screen because I just would like to share that with you. The idea of the four principle was to address the different actors on the stage. So first of all, public development banks. Yes, we're here, and we are one of the major players here because the public development banks have a pivotal role. They are issuers, they are standard setters, they are co-investors, and they can access to grant for technical assistance program. They can create the market. And then it's important to enhance the SDG alignment in the strategies, objectives, operation of public development banks, and I would say in the mandates of public development banks. Secondly, local issuer. Local issuer should be supported, but they have to ensure transparency. They have to ensure disclosure the disclosure in the issuance, and then countries. Third, countries ownership is important. It's important to tailor issuance to local context, and to support the development. They need to support the development of capital markets with the policy reforms, with the reduction of cost of issuing green bonds or sustainability-related bonds. And then, last but not least, the role of the donors, because donors must support with the risk-sharing instrument. That could be, for example, guarantees, first loss guarantees, guarantees on bonds. Mr. Moreira da Silva mentioned some bonds, the Ecuador example, or other bonds that have been guaranteed by a multilateral development bank. So the donors need to provide risk sharing and provide technical assistance, because the technical assistance, as everybody has already mentioned, must help in building the capacity and building the awareness of the local issuer. So these are the four principles that have been proposed by the Development Working Group under the G20 and have been proposed to the G20 summit. We're waiting for, we're quite optimistic. And then we hope that anyhow this high-level principle could serve as a basis for future G20 presidency, and also as a basis for community action that can involve private and public sector in order to go ahead. And as a CDP, I'm very proud to have collaborated with the OECD to the report, and that's all. Thank you very much.
Thank you so much, Marina, to highlight also the four high-level principles. Now, I understand we have 2 minutes left, so what I would like to do, give all panelists and Jorge basically in one sentences, what is the key message that people should take away from this session? And maybe I start with Anita. Over to you. 1 sentences, key message, please.
Let's all work together to create a bigger market for gender bonds to get rid once and for all of the scourge of gender inequality.
Thank you so much. Alain from BOAD, please, if you...
To share as much as possible any knowledge someone has, to share it with the others so that they can leverage on it and profit of this market of the green bonds.
Marina, over to you.
I would say holistic approach. So to support demand and supply, to support with knowledge and capacity the local markets.
Excellent. Thank you so much. Jan Martin.
Promote green bonds to raise funding for SDGs and Paris climate goals, but don't forget to build pipeline of decent projects that you can actually finance.
Excellent. Thank you so much. George.
Thank you, Haje. I think that my final takeaway is ensuring that this market is not just sustainable, but also reaches the equality that is needed. Thank you.
Thank you so much, colleagues. Thank you so much. A warm raise of hands here, clapping here for all panelists and George. Thank you so much for participating. Obviously, you see, we should have more time for this subject, but we will see each other next time at the next Finance and Commons Summit. Thank you so much. All the best.